Good evening, everyone. Welcome to our Georgia Tech Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you so much for taking time out of your day to be with us during tonight's class. Really excited to be able to present this content to you. This is a class that we put on for the Alumni Association 4 times a year. So we have quarterly classes that are available to you. And really excited that you guys chose this evening to be a part of tonight's class. This class is going to be recorded tonight. So all of tonight's content, we're going to have that recorded. We're also going to share back this video to all of the folks that signed up for tonight's class. And we're going to also share out all of our presentation material. So you'll have all that available to you as well. I'm just going to double check to make sure that we're good on video. Ken, I'm just going to do a quick check with you. Just let me know if we're good on the video. Want to make sure that we're running good before we get launched. Okay. All right. Ken's giving me the thumbs up, so we are good. All right. Well, thanks again for joining me tonight. My name is Jason Maida. I'm going to be your host this evening. Really excited to get a chance to spend some time with you. Our run time for tonight's class is going to be just about an hour. In the midst of class, we're going to kind of weave in questions that come in from our audience. This is a very interactive session, so we encourage those questions. You can use either the chat function in Zoom or you can use Q&A. We'll be monitoring both of those windows and we'll go ahead and get a chance to answer those questions on air. I'll also carve out a little bit of time at the end of class to go through any kind of follow-up questions that you might have. Just to introduce you to our organization. So I work with an organization called APM, or American Pacific Mortgage. We're the 9th largest direct mortgage lender in the country. Our team in particular specializes in homebuyer education. We do that through our different alumni partnerships across the country. So we have 16 different partnerships that are very similar to our setup with Georgia Tech alumni, where we help educate future first-time homebuyers on what's going to be, one of the largest financial decisions they make. So we put on classes like this. We'll teach over 10,000 students in first-time home buying. And then, I'll be your facilitator tonight. I'm also the one that would work with you in building your home buying plan. And we'll talk a little bit more about that after tonight's class. We have a really great level of participation for tonight's class. So I'm really excited to be able to bring this to you. And I think you're picking a really good time of the year with what's kind of going on economically to be a part of a class like this, because there is some excitement on the direction of interest rates. And so I'll be able to kind of share with you what we're seeing in the market landscape right now and kind of what's happening out there with inventory levels. But I think this will be some good information for you to be able to take away from tonight's class. Now, as we go into our talking points for tonight, I know we have a pretty wide national audience for tonight's class. So it would be really helpful for me to better understand where everybody's maybe thinking about buying or where you're located. If you feel comfortable, drop it in the chat where you're thinking about buying or where you're currently residing. That'll help us, because when we go into our discussion around kind of market data, we're gonna kind of specifically look at Georgia, but if we can get a better sense of other parts of the country where our audience is at, that can help kind of maybe help give you guys a little perspective on different areas that might be helpful for you as you're considering homeownership. So thank you so much, guys, for putting that in there. That's awesome. I'll kind of scroll through that and see where everybody's at. So that's great. And by the way, we are a national lender, so we can service in every market across the country. All right. So we're all over the place. So I'm certainly glad I asked that question. So I think we got every probably region in the country represented tonight. So that's cool. So we'll dive into that during our market data. Thank you for that. Here's our talking points for tonight. We're going to spend some time looking at the housing market. We're also going to spend time looking at interest rates, where we're currently at, what's happening, especially over the next couple weeks as it relates to maybe some Federal Reserve possible rate cut announcements. We're going to talk about credit tonight. How can we prepare? Maybe there's some areas of opportunity within our credit score. What can we do from that perspective? We'll talk about loan programs, savings for home ownership, which can be a bit of a challenge for some of us. How do we kind of build up enough resources to help get me prepared for home ownership? And I know we have a pretty broad audience across the country. We will also spend time looking at first-time homebuyer programs that are available in your respective markets, the buying process of home ownership, and then we'll kind of talk a little bit about like action items for you in terms of next steps from tonight's class. All right. So that's what our plan is tonight. Again, our runtime will take us up to about the top of the hour. We are recording tonight's class, and we'll share back out all of our presentation material. So let's kind of first start our conversation off by talking a little bit about does buying make sense for me as a prospective home buyer? I think it's really important for us as considering home ownership to take into consideration, especially from a budget perspective, like all of the benefits that come along with owning a home. For example, when I think about setting up my budget for home ownership, I can control what my monthly payment looks like on a monthly basis versus when I'm a renter, I'm kind of really at the mercy of what the landlord is going to increase my rent to. And maybe I have to make the decision to make a move and go to a different place. But in home ownership, I can really control my budget. Now, many of our buyers that are, or I should say existing homeowners that we have serviced over the last several years now have the opportunity to consider refinancing their homes, which is when you refinance a home, you're basically looking at the current market climate of interest rate and seeing if you can refinance your existing balance into a lower rate to create savings for yourself on a monthly basis. So even though you buy your house at X amount of payment, you can look to refinance down the road. That's a benefit of being a homeowner. This home purchase will be probably your biggest asset that you have, and that asset has the ability to grow over time. So as that home grows in market value, as I pay down my principal balance, I have the opportunity to create home equity for myself. And for most of us across the country that are homeowners, that is probably one of our number one asset. And it does have the opportunity to create more generational wealth for families. And there is still some tax benefits that come along with owning a home. So potential tax deductibility of mortgage interest, also potential tax benefits that could come along if I decide to maybe make energy efficient improvements to my mortgage or my home, I should say. So there's a lot of great things that should be kind of like factored into in my buying consideration, not necessarily what it looks like today from a rental perspective versus what I think I can pay from a home ownership perspective. All right, so that's kind of going to set us up for our next part of our conversation. And I saw a question that came in the chat, so I just want to address that really quick. So somebody asked, how much does it cost to refinance a home? So it really just depends on how you structure your financing. But generally, I would say refinancing a home would cost somewhere in the neighborhood of $3,000 to $4,000 between lender fees, title and escrow fees, the local county fees. So it really just depends. But in our kind of rationale or really approach, if you will, in refinancing, we want to make sure a client is at least creating about a 1% interest rate reduction in refinancing. So if my current mortgage today is at 6.5%, I probably want to refinance to a rate that's at 5.5 or less. Okay, so that's usually how we kind of think through that. But yeah, refinancing, we want to be careful because it's not one of these things that we would do as existing homeowners that doesn't come with a cost. And so that's why we want to make sure there's a good return on your investment. Generally, if you have at least a 1% interest rate reduction, you're going to be able to break even on those expenses in about 10 to 12 months. All right. Now, one of the things when we're looking at home ownership that we want to take into consideration is looking at the budget, right? And I've already kind of shared with you some of the benefits of owning a home. I want to now integrate that into one of our calculators, which is our rent versus buying calculator. As I mentioned earlier, we're going to send back out all the presentation material. I'd highly encourage you guys to maybe work through your own exercises with this calculator. I thought for class, I would just kind of share with you what this looks like. These calculators can be found on our website. We have different tools like the rent versus buy that we'll take you through now, when refinancing makes sense, estimated like basic payments, buying down rates, affordabilities. So there's a lot of cool things you can do with these calculators, but I thought I could walk you through this rent versus buying calculator. So if we took someone that's looking to purchase, let's say at 450 as a sales price, the minimum down payment purchasing at 450 is 3% of the purchase price. So essentially I'd be financing $436,500. If we assumed our interest rate of, let's say, 6.25% over a 30-year term of my loan, then that would give me my monthly payment, principal and interest on my mortgage, right? Now, then we also want to think about, when am I going to buy my home? So we have a start date of purchasing, which we can move that up to today. We have PMI, which we're going to spend some time talking about tonight, which is mortgage insurance when we put less than 20% down to buy our house. And then we have homeowners insurance. Now that's going to vary for those of us who are in different parts of the country. Homeowners insurance costs may look different on the West Coast versus the Midwest versus the East Coast or some of our Gulf states. But ultimately, we'll have a homeowners insurance budget in our home purchase. We have the cost of taxes that also vary by location. If we're choosing to buy a condominium, maybe a planned community or a townhouse, I might have homeowners association dues. And then we also want to bake into our homeownership equation, what's our tax situation look like? What tax bracket am I in? How much am I going to have in cost of my home? So the maintenance of my home, selling costs of my home, because ultimately, in our exercise here, we're saying, okay, I'm forecasting out at some point in time, I'm going to sell my home. And so that's the estimated cost as a percentage of the price for selling my home. And then we put in the appreciation rate of my home. Okay. So that would be the ingredients, if you will, from a home buying perspective. Now, where am I at from a rental perspective? Well, in this scenario, we have someone that's spending $2,000 a month in rent, paying 1.2% of their rental costs in insurance. And then we have someone that has their rent going up about 2% on an annualized basis. Pretty reasonable for some of us. That rent might go up even more so. But that is on the rent side of the ledger. So when we compare renting versus buying, our calculator looks at a break-even point of essentially 4 years. So what that means to us as buyers is that we'll break even in 4 years when we decide to buy versus renting. So once we get beyond 4 years, we're all going to be in the plus when it comes to asset accumulation, right? So look, if we look a little bit further, let's say after 10 years, I'm now on the positive side of owning versus renting for 10 years by $78,000. Now, I arrive at that number through the tax benefits of owning a home, of course, and the equity appreciation in my home if I was essentially sell my home in 10 years from now versus, like I said, renting for the next 10 years. So I would encourage you to run through this calculation yourself. I think it's a great way of kind of framing up home ownership, understanding monthly payments, but more so, how does that translate for me when I compare that to the rental side of things? All right. So we'll make sure that we get you all that presentation material out so you guys can take care of that exercise yourself. Now let's talk a little bit about the housing market. And again, thank you for those of you that decided to kind of drop your kind of prospective buying location or actual location into the chat. Let's talk about the national housing market and what's happening right now. You can see kind of the median home price slipping a little bit. We are seeing more inventory stack up across the country. I would say, if I look at inventory levels right now, we're probably at our best levels we've seen in the last 2 years. So we're seeing a lot more surplus in states like Florida, Colorado, Georgia, Texas. So we're seeing a lot more supply out there, which is giving buyers, of course, more choices. And even markets like California, some of our Midwest states, East Coast, we are seeing buyers with a few more choices because supply is up in most parts of the country. Now that can change, and we're going to talk more about interest rates and where we're going from that perspective. But clearly, there's more supply out there for buyers, and we're leaving the summer buying months. But it's interesting, the summer has ended, right? But that typically would usually kind of be the dwindling of the home purchase market. But honestly, it's continuing to go because we are seeing interest rates showing a glimmer of hope of interest rates going lower. It is bringing a lot more buyers back into the market. So as you're seeing supply stack up, you're seeing, prices slip a little bit. And by the way, in about 44% of all transactions being done across the country, they are including some type of seller concession, which basically means to us as buyers is the seller is conceding maybe a credit to help us with things like closing costs or some of our prepaid items when it comes to purchasing our home. So that's good news on the housing front. Now, from an interest rate perspective, we have even more good news. So just last Friday, we saw interest rates tick down to the lowest levels we've seen in about 12 months, which is really great news. Average interest rates slipped to about 6.25 to 6.3, depending on what type of product you're looking at. So really encouraging sign there. As interest rates go lower, buyer activity will generally pick up. So you'll see more buyers kind of leave the sidelines, get more active in the market. And we're certainly seeing that happen right now. So as I mentioned earlier, generally you'll start to see the summer buying season kind of dwindle a little bit right about now. But in most parts of the country, buying is still picking up. In fact, my sense is buying will probably pick up a little more because interest rates are projected to go lower. And we're really watching carefully for next Wednesday because the Federal Reserve is going to make their announcement on a potential rate cut. And so there's about an 86% probability that the Feds are going to cut rates by about a 0.25% next week. And that would be a welcome sign to, the lending space, right? And I think it's important to understand when the Federal Reserve makes those rate cuts, it's a direct one-to-one ratio cut in your credit card rates, car financing, lines of credit. In mortgage, it's not necessarily one-to-one ratio, but a lot of what we see in the mortgage activity space is kind of the precursor to what the Federal Reserve is going to move on the interest rate dial. So a lot of that stuff we've already kind of realized in mortgage interest rates. As we get more clarity on what the Federal Reserve is going to do with future rate cuts, and some folks are projecting another 2 rate cuts before the end of the year, that will, basically send another rate level or send rates go down another level. So, this is the look at the 12-month snapshot of interest rates. Again, we're definitely trending the right way. I think as our class goes, just know that buyers are going to start entering the market a little bit more actively given where the rate climate is going. Over the last 20 years, just want to kind of give you some perspective there. When we think about 20 years ago with interest rates, they look about the same. Home prices looked a lot different, as we can imagine. But as we go through major economic changes and cycles, you can see the changes of interest rates. This represents the housing crisis of 08, 09. Interest rates were not super low, but obviously what the distressed sales that were hitting the market, that obviously changed the climate there. And then, this gray bar here represents the pandemic. We saw interest rates eventually get to the lowest levels historically. I like to kind of share that with our classes because I think some people are thinking interest rates will return to 2.5%, whatever the level was. Not likely. Of course, if that happens, then something kind of catastrophic has happened globally. So when we think about the historical level of interest rates, they're generally going to be floating around the high fours to low fives. That's generally what we kind of see in the interest rate space. So even though we've had some improvement over the last week in interest rates, we're still at higher levels, but rates will start to normalize. It's not a question of if, it's more of kind of a when type of timing situation. Now, interest rates are not the same for everyone when we think about home financing. There's a variety of different characteristics that go into an interest rate, things like credit score and eligibility, the type of product I'm going to do, how much I decide to finance, what my down payment looks like. You do, as a consumer, have the option to buy down your interest rate, which basically means I'm paying more funds out of pocket in order to bring down my interest rate. That's called points. Points are usually the equivalent of 1% of my loan amount. So if I said, hey, I'm going to pay 1 point on my loan, that would generally drive down the interest rate on my mortgage by about 0.25%. Now, in today's market, where, as you just heard me say, we're seeing interest rates kind of trend down, it doesn't make a lot of sense for those to pay points because most of our clients, and we've talked about refinancing already in class, they're probably going to consider refinancing in 2 to 3 years if they're going to buy their home in today's market. And then the loan term can also change what my interest rate might look like. So usually the shorter my term is of my loan, the lesser cost I'm going to pay from an interest rate perspective. Now, ultimately, as we kind of build our home buying plan with you and kind of go on this journey towards home ownership, we're going to figure out what the right design work looks like for you for home buying. But ultimately, you do have options in terms of how your interest rate is set up. And the overarching kind of biggest influence of interest rate is ultimately kind of what the market is doing. Now, one of those other characteristics to go into interest rate is credit score. And so what we like to do in classes is just kind of explore, like, what does credit look like for us? Let's identify some areas of opportunity and give you some tips and resources to maybe get your credit report to the next level of score. Now, I think it's important to understand that every loan product does have a minimum credit score. And so we've kind of highlighted some of these core products here on screen and those minimum score requirements. We're going to dive in a little bit deeper in class on the actual guidelines to some of these programs because I know many of you have heard about the terminology of these products, but we kind of want to put it all together for you. Now, when we look at credit scoring and mortgage, we are going to look at the mortgage score for qualifying. Now, there are 3 different scores to credit scoring. There's the credit card score, which, by the way, that's used for most of your credit monitoring services. There's the auto financing model. So if I'm going to go buy a car, and then of course the mortgage model for housing financing. So we are going to look at that score when it comes to qualifying. I am going to show you what the weighting looks like for that score. Keep in mind, each agency that's out there, right? So Experian, TransUnion, Equifax, each has their own risk model and reports back their own individual score. In lending, we always take the middle score of all 3 borrowers. All 3 scores for each borrower. So if I have, let's say my top score is 760, my middle score is 740, and my lowest score is 720, from an eligibility perspective, we're going to take the 740 score for qualifying. Now, if I'm looking to qualify with my partner, and let's say my partner is at 720, 700, and then 680, 700 is the lowest middle credit score between the 2 of us. So in that scenario, that 700 score would be used for qualifying purposes. Also, it decides the interest rate selection. In fact, I had a question that came in from one of our clients we're working with today, which is, if I'm going to have someone co-sign for me on my loan, my credit score, let's say, is 620, right? If I'm going to have someone co-sign for me and they have a 720 score, does that 720 score supersede the 620? So it actually isn't the case. Even if we have a co-signer, the 620 score is the lowest score between the two of us. That's what would be used for qualifying purposes. All right. Now, when we think about events on our credit report, like challenges, late payments, over limits, collection accounts, whatever the case may be, when that event hits my credit report in the most recent 12 to 24 months is going to be the impact to my score. And then as I move further away from that event, the lift I'm going to see in my credit score. So if I had a late payment on my student loan back in October of 24, as I get past the first 12 months, so let's say November of this year, then I'm probably going to see some lift in my credit score. As I get beyond 2 years, then I might see probably even more credit score improvement. Now, if we've had some past challenges, kind of bigger events on our credit report, this is how long they will stay on our credit report. But the impression, or the impact, I should say, to the credit score is in the most recent 12 to 24 months. So my example of the student loan late payment, like that's going to stay there for 7 years, but the impact to my score is going to be in the most recent 12 to 24 months. All right. Now, one of the things that we want to kind of look at is also the actual mortgage credit score, because what I would like our class to do is, like, as we go through kind of this wheel of waiting for credit score, let's look at maybe some of our own personal areas of opportunity. And so let me kind of explain to you each one of these categories. And, this will probably kind of maybe spark maybe one or two action items for you. But the first section would be length of credit, which essentially is how long have I had credit? So the more mature my credit file is, probably the higher my credit score is going to be. Now, if I compare someone's credit profile that's had credit for 6 months versus someone that's had credit for 6 years, all things being equal, the person with the 6-year credit history probably has a little bit of a higher credit score. And that's 15% of the weighting. And then we have new credit that we're trying to get access to, which is 20% of the weighting. So essentially, am I trying to open up new accounts? Do I have new inquiries on my credit? So do I have what we call as hard inquiries on my credit, especially in the most recent 6 to 12 months? Now, we want to avoid hard inquiries, but there are some rules in place to protect you as a consumer around both home financing and auto financing. And that states that if you're deciding to shop for home financing, you have a 30-day window of time to shop around with many as lenders as you'd like to. And that's the equivalent of one credit inquiry impact to your score. That same rule holds true with auto financing. Now, one of the unique kind of ways that we approach things, because obviously when we're looking at home financing for our clients, we don't start with a hard inquiry. We actually start with a soft inquiry. And the reason why we choose to do that is we want to help build a plan for homeownership for you, but not impact your score right away. So many of our clients are considering homeownership, but maybe on a maybe longer timeline, maybe it's 1 to 2 years. We want to give you some tips and resources to build a plan without impacting your score. So we always start with the soft credit check. Now, the next part of the weighting is going to be probably the most opportunistic area for most clients is around credit utilization. So we're looking at revolving debts, credit cards, lines of credit, comparing what my outstanding limit is versus what my outstanding balance is. So the rule of thumb is we want to be at optimal level 10% or less on those balances. So if I have $10,000 in limits, I really want to try to, if I'm trying to optimize my score, get below $1,000 in outstanding balances. Now, I know that's not always attainable for all of us, but if we're higher in utilization, let's say we're at $8,000 in balances with $10,000 in limits, our first action item is to get to below $5,000. As I achieve that level, get to $3,000, and then optimal would be about $1,000. If you take a look at one of your credit card statements, this is kind of be like maybe a homework assignment for tonight. If you take a look at one of your credit card statements, there are two important dates. One is there's a billing cycle date. There's also a due date. The billing cycle date is what I like you to kind of take a look at. And that essentially is the date at which the credit card issuer is going to send out all your credit card information and activity out to the 3 credit reporting agencies. So my tip for our class tonight is if you can try to pay down that balance, or ideally pay it off before the end of the cycle or statement date, then what you're going to do is you're going to bring down your balance lower before the reporting happens. And then you're essentially going to lower your credit utilization, therefore lifting your credit score. All right. So a lot of us get in the habit of paying our due date. Certainly nothing wrong with that. But if you're really trying to optimize score, try to pay off before the end of the cycle date. All right. Last section is going to be payment history. That's pretty self-explanatory. That's essentially how have I paid my bills, especially in those most recent 12 to 24 months. So if I had that late payment, like I mentioned earlier, October of 24 on a student loan, probably getting hurt me there on that side of it because it's 35% of my score weighting. As I get further away from that, I should see some incremental lift in my score. Now, one of the other things that we see on credit report is student loan activity, right? And student loans are kind of in a weird place right now because some of us are still in forbearance, some of us are in active repayment, some of us just don't know what status we're in. And so, that status does play a role on your eligibility for qualifying for your home financing. Now, if you're in an active payment plan, whether that's a standard payment plan or even an income-based repayment program, we can use that payment right away for qualifying. So if I have $75,000 in student loan debt and I'm on a $250 reduced payment plan, we can use that for qualifying right away. Now, where it gets a little more challenging is if that I'm in active forbearance or maybe I'm in deferment and so I'm not making payments, then it depends on the type of product that we're electing on how we would view the minimum payment for qualifying. So if we're going to do an FHA loan, we would take 0.5% of the balances. So that would be what, 375 is the monthly payment. If we're doing a conventional loan, it could be 1% of the balances, which would be 750 on a monthly basis. So that's important to understand if you do have outstanding student loan debt. Now, I'll help you through understanding how that calculation impacts your eligibility. But ultimately, I think the takeaway here is that we do have to take student loans under consideration, but it shouldn't be a deterrent from you in considering your home buying options. So if you're, again, just to kind of recap here, is if you're in forbearance or deferment, we still have to count a minimum payment for qualifying. And we do have some clients that are also in like public forgiveness programs where they're working for a public agency and they have 10-year forgiveness options. That's great. But until those loans are forgiven, we still have to count a minimum payment for qualifying. Now, the reason why we have to take student loans under consideration is because every loan program that's offered to buyers has guidelines or underwriting guidelines that basically tell us what we need to do as lenders to make sure that a client meets certain qualifying parameters. And so in this part of tonight's class, I want to kind of just walk you through like more of a high level look at each one of kind of the core programs that are available to you. Because you've heard this terminology before, but I just want to make sure we can kind of tie it all together for you. And the first loan is a conventional home loan. That is a Fannie Mae or Freddie Mac loan. You're seeing Fannie Mae and Freddie Mac in the news a little bit right now. I know there's some talk around taking them private. They're currently kind of under government conservatorship, but there's some kind of back and forth around, what to do with Fannie Mae and Freddie Mac. But ultimately, Fannie Mae and Freddie Mac has about 60 to 70% of all originations across the country. So as a lender, we work directly with them in basically in partnership with their guidelines that they have as a resource. The minimum down payment for a conventional loan is 3%. You can see the minimum credit score. And every year we have the conforming loan limit, which this year is 806,500. That'll get updated around October or November based upon cost of living adjustments. Now, I know we have some attendees in tonight's class in what we call high cost of living areas. I think I saw Seattle. We saw maybe some California represented, New York, certainly. Those markets have higher limits. They go up to $1,209,850, which is called the high balance limit. In those markets, you can go up beyond the conforming limit, but the down payment elevates from 3% to 5%. The next product is a government insured loan. That's called FHA, which is also stands for FHA stands for the Federal Housing Administration. Minimum down payment of 3.5%. You can see the minimum credit score. And then the maximum loan amount will vary based upon the county at which you want to buy in. Now, I want to kind of put together both the FHA and the USDA product, because those are both government insured loans. The USDA product does not have a minimum down payment requirement. It does have the minimum credit score, as you can see here, and a maximum loan amount that differs by the area that you want to buy in. And there's income limits based upon the household size that you want to purchase in. USDA is essentially a rural product. So if I'm looking into purchasing a rural part of the country, USDA could be a resource for me. Now, these are both government insured loans. And unfortunately, there was some changes as it relates to both of these products in relation to residency status. So unfortunately, you have to be a permanent resident to have access to these programs. So 2 months ago, unfortunately, changes were made to the guidelines for these programs that required that permanent residency. Now, you can still be a non-resident and have access to financing. It would just have to be under the conventional home loan product. And then the VA home loan is for those that have eligibility under the VA home loan. They'll usually have a certificate of eligibility that shows the eligibility for that product. Does have a minimum credit score requirement, no maximum loan amount, believe it or not, and it is reserved for veterans that have access to the VA home product. And then the jumbo loan is not going to be something necessarily for our first-time buyers, but it is accessible to you as a buyer, has slightly higher down payment requirements, higher credit score requirements, and it generally is going to be a resource for those that need to stretch beyond maybe the capabilities of Fannie Mae and Freddie Mac loan limits. Now, I had a question that came in the chat, which is if you put less than 20% down, does that lead to a higher interest rate? So interest rates can be scaled by credit score, down payment, and how much you finance, and also property type to a certain extent. So if you're financing a condominium, that condominium could be a little bit more expensive than, say, a single family residence. But usually interest rates are scaled with the following down payments: 3% down, 5%, 10, 15, 20%, and then you jump to 30% down. That will change the interest rates. All right. Now, one of the things that also can change your expenses in your home financing is what we call mortgage insurance. And so if I decide to put less than 20% down to purchase a home, I will cross into what we call mortgage insurance. So there are two different areas of mortgage insurance. One is PMI, which is private mortgage insurance. The other is upfront mortgage insurance. And I'm explaining both of you tonight what those look like for you. Now, PMI stands for private mortgage insurance. And then you have MIP, which is on the government side, or mortgage insurance premium. Both are designed to protect the lender against defaults by the buyer. So if there was economic challenges for the buyer, mortgage insurance would kick in to protect the buyer. Now, or protect the lender, I'm sorry. On PMI, the way it looks like this: PMI is calculated based upon credit score, down payment, and how much you finance. So the more I can put down, higher my credit score is, the less I finance, the cheaper my mortgage insurance costs are going to be. There's about 7 to 8 different mortgage insurance companies that we partner with across the country, and they essentially have a risk scorecard that's made up by these 3 components. Now, PMI has a cancellation option on a conventional loan that when I reach 2 years in the loan and I have 20 to 22% equity, I can apply to have that mortgage insurance canceled. Now, many of you that have started your searches on Redfin or Zillow and maybe using some calculator features, there might not be a true depiction of really the cost of mortgage insurance. It's generally inflated a bit. But from a kind of a true mortgage insurance perspective, if we finance, let's say 450, as you can see in our example here, let's say we had a 740 credit score, we're putting 3% down, our mortgage insurance costs are about $138 per month. All right. Now, the higher I can elevate my credit score, the more I can put down, the lesser I can spend in those mortgage insurance costs. The other side of it is MIP, mortgage insurance premium. That looks a little bit different because there's 2 forms of mortgage insurance. There's monthly mortgage insurance, which is calculated at 0.55% of my loan amount. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. And that gets added into my total amount financed. So this is a government insured product. And unfortunately, the only way to cancel mortgage insurance with an FHA loan is I'm going to probably have to refinance out of this loan into more of a conventional product. So we generally look at the FHA product as an option to help clients get access to home ownership. Probably not going to be the forever loan because FHA, as compared to conventional loans, has a lot more leniency when we think about late payments, credit scores, maybe some of the asset requirements. It's going to be a little bit more flexible on the FHA side. So if we can use FHA as a resource, then generally in 1 to 2 years, as clients see some financial improvement, we're going to probably try to look to refinance into a conventional loan. Now, if we take a look at the PMI example, the MIP example on FHA, we take the same 450 loan amount. We have the upfront mortgage insurance. We're probably spending about $206 per month on FHA mortgage insurance monthly. And then, of course, we have the upfront mortgage insurance of $78.75 that gets added into the total dollar amount of the amount financed. All right. So we get a lot of questions around PMI. So hopefully that kind of gives you a little bit more familiarity with how PMI works and the different options for you as prospective buyers. Now, let's talk a little bit about employment for home ownership. And, I get a lot of questions around, does my income qualify? How long do I have to be on my job? So we want to kind of give you a little bit more context to employment and how that impacts you or helps you in home ownership. Now, I did want to pass along just a really helpful guide on general documentation requirements in preparing for your home buying plan. So here's just a quick checklist of items that you can take away. If you're thinking about taking the next steps in home ownership, this is generally what the things that you would want to prepare. Now let's talk a little bit about employment. And so in lending, we always have to verify a 2-year work history. Now that 2-year history can also be inclusive of educational history. So if, let's say, for example, I graduated from Georgia Tech in the fall, started my new job January 1, as long as I can piece together my educational background and my new job starting on January 1 that makes up a 2-year history, then that can be used for qualifying purposes. So I'm essentially having to piece together a 2-year history. Doesn't mean I have to be on my job for 2 years, which a lot of people think they do have to be. It's just showing a full 2-year employment slash educational history. Now, where the 2-year history requirement gets a little bit more in depth or more requested of a client is that if I'm in a variable compensation position, so let's say I have bonuses or commission income in addition to a base salary, in order for me to count those variable sources of income or even overtime, I have to show that I've been on that job for 2 years. Okay, so that's where the 2-year rule comes into place. If I'm self-employed, and let's say I'm an independent contractor or I built my own business, then I do have to show 2 years of tax filing in order to use that income for qualifying purposes. If I have dual employment, so let's say I work for two different employers, I work 20 hours at one, 30 hours at another, technically part-time, but I want to use both sources of income. In that case, I have to show that I've been on both jobs simultaneously for 2 years. All right. We also have clients that maybe have a 40-hour work week job that also drive for Uber on the weekends or maybe just have a secondary position. If I want to introduce that secondary position, then in qualifying, I do have to show that I've been on both jobs simultaneously for the last 2 years. All right. And then last thing I would just actually two things I want to point out to you. If you're in some of our clients that are in work for technology companies or startups that are getting restricted shares, RSUs, those sources of they're sources of assets, but those can also be amortized into income as long as I've been with my employer for at least 2 years. And so that can be potentially added in RSU and just the vested shares of RSUs. Also, if we have someone that's applying for a mortgage, has additional sources of income like a partner that's contributing to the household income, unless that partner is going to be part of the application, then we can't introduce that income for qualifying purposes. All right. So hopefully that's helpful. I get a lot of questions around that. So I think that hopefully, dispels some of the myths around how long I have to be on my job to qualify for a mortgage. When we think about what income can be used to qualify. Now, we also evaluate your expenses versus income. And we call that calculation debt to income ratio. That essentially measures as a percentage how much of my income is being consumed by my outgoing expenses. Things like credit cards, personal loans, car loans, even the projected housing payment that you're going to pay on our mortgage, right? So if we were to think about someone that's paying, let's say, $3,000 a month, and we have kind of a calculation built here for you. So let's say we have someone that's paying $2,500 in projected housing expense between the principal and interest of their new loan, the property taxes on their house, the homeowner's insurance, maybe HOA expenses as well. Let's say that's $2,500. And their other debts, their car payment, maybe a credit card is $500 a month. So we look at those expenses, which are $3,000 a month, versus someone in their pre-tax income at $8,500 a month. That essentially calculation tells us that 35.3% of this income is being consumed by those expenses. Now, our underwriting guidelines allow us to go to 45 to 50%, but keep in mind we're using a pre-tax number. So when we start to get to those higher levels, 45, 50%, that's obviously something we're gonna have a conversation around just to make sure we're hitting the mark from an affordability perspective. The question I get from clients is, what should be a good targeted range for me from a debt to income ratio standpoint? And I would say, excellent for most clients is if we can have a debt to income ratio around 33 to 36%, that would probably put us in a really good affordable range, our comfort zone. But we can qualify as high as 45 to 50% with debt to income ratio. All right. The last component to what I would say building a plan for homeownership, other than the process, is better understanding, what is my down payment going to look like for homeownership and how much do I need to save? Am I currently right there, or do you need to kind of work towards a savings goal? Now, I did before we kind of talk about a savings plan for homeownership and down payment requirements, I did want to pass along some of the acceptable sources of down payment. ways that we can validate your existing resources towards home purchase. Things like obviously checking and savings accounts are allowed. Cash deposits cannot be used in a home purchase. So that's always kind of important to understand. You can use retirement accounts or borrow against a 401k or a 403b, access brokerage accounts. I always encourage clients talk to your tax or a tax advisor or your financial advisor before you make those decisions, so we don't create a tax consequence or lose appreciation in the markets. Gift funds can also be used in a home purchase. Those funds do not require any type of seasoning requirement, but there's a documentation process for that with gift funds, right? So when we think about home ownership, and saving for it, and by the way, this is probably one of the bigger challenges for most buyers is just saving enough money for down. As we learned earlier, the minimum down payment on a conventional loan is 3% of your purchase price. Now, one of the other expenses that we wanted to keep in mind is also closing costs and prepaids for our home purchase. I always tell clients to budget themselves about 2 to 3% of their sales price for those expenses. So when we think about, let's say, a $400,000 home purchase, we're probably going to have to save up $12,000 for our down payment and probably another $8,000 to $12,000 for closing costs. So, worst case scenario, maybe $24,000 in total out of pocket. And we're going to talk more about assistance programs that can help you as well. But as we think about a goal towards savings, that's generally what would be the baseline. Now, if we're in a really good position from a monthly budget perspective, but maybe the gap is really in our savings, here's what I would encourage our clients to do. So if I'm currently, let's say, spending $1,500 a month in rent, but I know with my goals of home ownership, I want to buy something that puts me around, say, $3,000 a month. Right now, we have about a $1,500 variance, right? So what I would encourage our client to do is if we're lacking savings right now, so let's say we're missing that $24,000, maybe we're just a little bit short. What I would encourage our client to do is let's start making payments today into our savings account like we're actually paying that mortgage payment of $3,000. So on the first of the month, I pay my landlord the $1,500. I kind of create that discipline or habit that automatically another $1,500 goes right to my savings account. Now it's a $3,000 outgo, but it's doing a few things, obviously, right? It's growing my savings account. It's also creating that discipline and the habit of paying $3,000 on mortgage, so it's not such a big sticker shock when I eventually have to pay that mortgage in the future. Funny enough, I was working with a client yesterday that in July of 2024, we put this exact plan in place. And at that time, he was very limited on his buying power because of lack of resources. He has since done that plan for exactly 12 months. And he basically increased his buying power by about $200,000 in his home. So he went $400,000 in purchase price, and I think we pre-approved him for like 625 just yesterday. So it does work. I would encourage you to do it. It is a simple approach, but it does create a really good habit for you in savings, but also kind of like getting yourself calibrated to take on that mortgage payment. All right. Now, I do want to pass along some resources as it relates to assistance programs. Now, I know we're in different parts of the country. So depending on what market you're in, generally most states have what they call is a housing finance agency designed to support low to moderate income housing in first-time home buyers. And so, we can talk offline. We have a pretty big audience tonight, so we can talk offline for specific markets that you would like to buy in. But for those of you that did put your location or prospective location in the chat, definitely there's programs available there to support you. Let me kind of spotlight a few of them. Nationally, Freddie Mac for low income buyers, which basically means if I make less than 80% of the median income, you can get grants of $500 to $1,000 towards closing costs and down payment. I know that's not a big one in terms of resources, but other programs can be quite significant. So our pathway program we have internally with an APM offers anywhere between 3.5% to 5% of your purchase price in assistance funds. Now that's only positioned with an FHA loan, but that could be a really great resource for you. In Georgia, there is the Dream Homeownership Program that provides anywhere between $10,000 to $15,000 in assistance. You do have to be considered a low to moderate income first-time buyer. I don't know if we have anybody in from California, but if California does have an HFA too, anywhere between 3% to 6% in assistance. So there are plenty of resources out there for you. I think just a lot of people don't realize that. And so it is catered towards low to moderate income. So low income would be someone making less than 80%. Moderate income can be 100%. Some states like California goes up to 150%. So I would say just check with me offline. We can talk about your respective state. We can do a little bit of research just to see what resources are available to you. We did have a question that came in. Do you have to be citizens to apply to these programs? Not necessarily. No, you can be, you don't have to be permanent residents for these programs. It depends on which state. The state may have a requirement, but if you're a non-permanent resident, the conventional loan would be an option for you. And most of these assistance programs will comply with non-permanent resident conventional guidelines. Okay. All right. Thank you for that question. I just want to walk you through a first-time buyer scenario just so you can kind of have a kind of idea of what the cash out of pocket could look like with and then without first-time buyer programs. And then we'll talk a little bit about the buying process, and then we'll wrap up tonight's discussion. But this is kind of what a general scenario would look like in first-time home buying without assistance resources. So, we've seen this kind of example a couple times. If I bought at 450, I have my minimum down payment here of 3%, and then those closing costs and prepaid items are generally 2 to 3% of the purchase price. So someone would expect to have about 22 to 27,000 cash out of pocket, right? Typically. Now, if you're looking at a first-time buyer program, let's say like if you're looking to purchase in California or Texas or whatever, you could have a resource that could provide maybe 3% of your purchase price and assistance that could cover the minimum down payment. For example, in California, we have the My Home Assistance Program. There's also generally some type of closing cost assistance program. In California, there's the My Access program. And so, a scenario like this where a first-time buyer is saying, well, I have to save maybe 22 to 27,000, we can overlay or integrate first-time buyer programs and now maybe reduce that down to a fraction of what you anticipated coming out of pocket without the first-time buyer program. Okay. So I would encourage you to connect with us to talk about first-time buyer programs. I think that's a great resource to maybe make homeownership more of a near-term goal for you. So we take it from a 3 to 5 year goal, maybe to a 1 to 2 year goal for you. Of course, we would always encourage you to kind of develop that savings plan for yourself as well too. All right, so let's now talk about the buying process. And so, where do we go after tonight's class? We've had a really great audience here, and we have a lot of great a lot of great participation tonight. But I think it's important to understand where do we go from here, and like how do we what's our action items? Well, we would encourage you to get connected with us for a consultation, which is a free service we provide to help build a home buying plan for you, whether you're going to buy next month or 2 years from now. At least you understand kind of what your goals and objectives look like for home ownership. Now, after we complete a meeting like that, and this goes for most lenders, you do have pre-approvals that are issued to you as a buyer. But our process is a little bit different because it's very more consultative in our approach, designing affordability options. But the output of that session we do with you is to deliver what we call as a pre-approval letter, which essentially allows you to go out and confidently do home shopping and make an offer on a home whenever that right home it presents itself, right? Now, a pre-approval is good for 60 days, but there really is no rush to go out and buy a house. The application that you deliver to us online is good for 2 years. So there's a lot of flexibility in the timeline. As a reminder, we only do a soft credit check when we build your online application. Now, from step 1, we move to step 2, and so that's the home search of the process. So generally, you're going to be kind of starting online, maybe kind of identifying some neighborhoods or communities that work for you. Then we would encourage you, after you've kind of figured out where you want to buy, to connect with a local realtor. We do have preferred realtors that we work with across the market. We can always make an introduction for you if you need that resource, but we encourage you to take advantage of the realtor resources, because ultimately they should be experts in where you want to buy. They should be experts in negotiating. They should have some relationships in market to, really be able to house hunt properly for you. So that would be, an advocate for you in your home buying process. Now, house hunting can generally be one of the longest phases of the process, right? Some clients, it takes 2 to 3 weeks. Sometimes it's 2 to 3 years. It really just depends, depending on if you're looking at a specific area. But as you go through the home shopping, our team's going to be here to help support you and run different payment calculations or any questions you have as you're looking at different options available in your market. Now, once you identify a home you love and you want to present an offer to a seller, a realtor will help organize that offer, and then we'll present it to a selling agent. Now, if that offer gets accepted, then now that means we have a ratified agreement between you and the seller. And that really starts the next timeline, which is basically the escrow process. That really runs us from step 3 to step 6. In most parts of the country, that process is going to take about 30 days. Some markets that are a little bit more competitive could be shrunk down to 14 days. It really just depends. Now, the day that we get advised that you have an accepted offer, you're going to get a call from us saying, congratulations, you have an accepted offer. Super excited for you. Let's talk a little bit about your next steps in the process. Let's get you scheduled for a follow-up video session so we can kind of help you understand where the market's at. Let's talk about your interest rate now that you've selected a property. Let's talk about what you have out of pocket, estimated payments, all the really important things for you. And I meet with every client across the country as they go into contract and make sure that they understand all their options around homeownership. Now, there are also other action items that you'll do as a buyer once you have a ratified contract, like making an earnest money deposit, which is usually 1% to 2% of your purchase price. Now, that money is essentially a good faith deposit that counts towards your total out of pocket. And there are some protections in the contract for that deposit. Because in most parts of the country, you have a contract that has contingencies to it, which essentially allows you to do some of your investigative work on your respective property. That also includes getting your house appraised, which as your lender will help organize that. You'll have your inspections, which your realtor will set up for you. And then finally, we'll make sure we get your loan approved. And so the deposit is protected within that contingency period because we want to make sure this is a sound investment for you, right? And so we want to make sure you can do so confidently without risking the investment you've made in the house. Now, step 4 is going to take us to more of the administrative functions of the process, doing things like verifying employment, verifying assets, make sure the product is structured correctly. Now, once we've gone under contract with the seller, especially in this market where we're seeing interest rates go lower, we're really going to work strategically with you to make sure I can secure the lowest interest rate for you. So we're going to really be watching trends in the market to try to lock in lowest interest rate, because until you find your home, that interest is kind of floating with the market conditions. But once you go under contract, then you're eligible to start locking in your interest rate. So we want to be very strategic in when we do that interest rate lock. Step 5 is going to be the loan approval phase. So that means your loan has been underwritten by an underwriter, issued an approval. They verified income, assets, your credit, make sure everything's all good. And we've also, by that time, also gotten your appraisal back to make sure the value supports your purchase price. All right. So now we're almost about 3/4 of the way through the process. It also will bring you to the end of your contingency period. So you can also, make sure that you feel good still about the home purchase. If you do, then you can release your contingencies because now you have your approval back, your appraisal, everything's all good. And we issue a final disclosure to you called a closing disclosure. It does give you a 3-day cooling off period before we get to the very final stage of closing your loan. Now, throughout the loan process, you get disclosures sent to you that are e-signature disclosures. They're all kind of showing the different progressions of your loan, the setup of the interest rate, loan amount financed. And as we move through the process, you'll be getting updates throughout. Now, step 6 is the final day, which is essentially the closing of the loan day. And so that means you're signing final loan documents on that day. You're also delivering your final funds for closing. And you'll be meeting with the public notary on that day to sign those documents. Usually that takes about an hour or so. Again, like I said, you deliver your final funds on that day. We wire in the funds for your financing. And those monies get basically settled with an escrow or attorney's office or a title team, depending on what state you're in. And then documents get recorded with the local county recorder's office. They'll record a grant deed to transfer ownership. They'll also record a deed for the loan agreement, essentially. And once we get reported back that everything is recorded with the local county, then we get a chance to call you and say, congratulations, high five, you did it, you're now a homeowner. And I got a chance to actually make a call right before our workshop today to be able to say, congratulations, you did it. We had a family in San Diego that purchased their first home, part of our USC partnership, and really excited to help them on that journey towards homeownership. In fact, they came to one of our classes just a couple years ago. So it can definitely happen. It's a huge financial accomplishment, and we want to obviously be a partner for you on that journey. If you're thinking about moving forward and want to just know what your options look like, I'd love to be able to get connected with you for that free consultation to help design some home buying options for you. We have a real simple 3-step process. We call it our Get Started process. You'll do an online application. You'll get that filled out. We do a soft credit check. You'll upload documents. And then you use our scheduling system to schedule a call time that works convenient for you. I do meet with clients virtually, so it's all on Zoom. We do screen sharing so we can look at different scenarios, use our calculators, just ultimately design a comprehensive plan and budget for you around homeownership. All right. Now, if you do have some questions that and we're going to open up for Q&A in a second, but if you want to schedule a call time with me, you can use our introductory call scheduling link. And you can also find that on the scheduling system. We can schedule a 10 or 15-minute call. Maybe you just want to run some questions by me or talk about first-time buyer programs, whatever the case may be. Here's what our consultative service looks like. It is different than what most lenders do because we want to take a vested interest in making help you with a great financial decision. So we want to learn more about what your goals in home ownership look like. And so it starts with, where do I want to buy? What are my areas of opportunity and credit? What does my budget need to look like? Let's make sure I understand that we can look at any type of or identify any first-time buyer options. So a lot of important things will come out of that consultation that we do with you. And that's about a 30-minute, like I said, virtual session. Want to just point out one of our technology resources. We understand how to leverage technology, whether it's through mobile or AI functions within some of our features online. But that doesn't replace the human touch. We're accessible to our clients for whether phone, call, email. We understand this is a huge, major financial decision, so we always want to be accessible to our clients. But mobile is a great way to see how your loan is progressing, use the calculator features. You can even start the loan application process all through mobile. Last thing I want to point out to you, and then we're going to move over to Q&A, which is our exclusive discount to you in the Georgia Tech alumni community. So we actually discount our services for you. So if you decide to work with us in your home financing, whether it's purchasing a home or even refinancing, you get a discount in closing costs. We always have access to our free classes that you're joining us on tonight. So those will always be available in the future to you. If you have friends, family, coworkers that you think would enjoy this content, feel free to have them sign up for one of our next live classes. Doesn't necessarily have to be which is Georgia Tech, but you'll see all of our classes available at mortgageeducate.com. And of course, this recorded version of tonight's class will be up on our YouTube channel tomorrow as well. And you can see a list of our other partners that we have all across the country. All right, here's all my contact information as we're kind of rounding the finish line. Feel free to reach out to me, call, email, text, whatever is good for you. I also wanted to put up our scheduling link again here so you can check out that. And then just finally, I just wanted to share with you our socials. We love what our community says about us. We understand what a privilege it is to support you on this journey towards homeownership. We don't take our role in that process lightly at all. And I think our community testimonials say a lot of how we support and get the trust of our clients. So we'd encourage you to see what our community says about us on our Google, even on Reddit. We have a lot of great, just kind of more support testimonials out there from some of our clients across the country. So with that being said, I do appreciate you taking time out of your busy Tuesday evening to be a part of tonight's class. Hopefully you got a few great takeaways to help you on this journey towards homeownership. I am going to open it up for Q&A. Love to be able to answer any questions you have. I know we also kind of woven some questions through the chat, but we have a few more minutes before the top of the hour, so we'll stick around for any questions that our audience has. And thank you for the positive feedback. I appreciate that. All right, any questions from our group? I know I'm probably either right in the middle of dinner time or depending on what time zone you're in, right before dinner time. So, okay, so question came in, which is, in the DTI, debt to income ratio calculation, does debt include monthly credit card and payments? Yes, it does. So it includes the minimum payment on a credit card. Now, if you pay off your credit cards monthly, which is great, when we do a consultation with you, we'll talk through what credit cards you do pay off monthly, and then we'll exclude those from the debt to income ratio. In fact, I had a conversation with a client today. If you have like 30-day accounts, like Amex accounts, where you pay them off every 30 days, usually those, because they have larger minimums, like let's say I have a $1,500 balance, the minimum shows is $1,500, that'll automatically get excluded generally from the debt to income ratio calculation. You're welcome. Awesome. Thank you so much. I appreciate all the positive feedback in the chat. That's really cool. Anything else from our group? Okay. All right. Awesome. Well, thanks again for being a part of tonight's class. Hopefully you enjoyed what you heard. I hopefully get a chance also to get connect with all of you to help you on your journey towards homeownership. Have a wonderful evening. We'll see you soon. Good night.